Hey, everybody. Burt Copeland with New Life CFO Services. And I want to thank y'all for spending some time with us this afternoon to really dive into part 2 of our accounting wellness series. It's a 4-part series. And the overriding premise is it's really hard to make good decisions based upon bad numbers. Or if it says right here, bad numbers lead to bad decisions. And we're going to go through a couple of examples on that. Just as a reminder about where we have been in this series, in part 1 of the series, we talked about accounting ROI and the symptoms of whether your accounting process and system is sick. And today we're going to go over accounting qualifications and do you have the right people and what does that look like if you don't? And we're also going to go into reporting excellence, which is not only a great way of making yourself informed about what's going on in your business, it's also a great way of monitoring, is everything working good behind the green curtain, as some of us refer to it. On June 16th, we're going to go into part 3, which is accounting systems and snare traps. It's very frequent that people end up buying a Bentley when they need a bicycle and add so much complexity to their company that it really just doesn't work well anymore. Lastly, we're going to touch on accounting black holes and fraud prevention. Not necessarily accounting wellness per se, but we think it's very important that you understand how these things work. Now, just as a reminder about accounting ROI before we dive into that, because that's really why we're all here, is why does this matter and what's the payback? Too often, accounting is looked at as an overhead, a necessary evil, stuff that happens back there, and I really don't want to hear about it. But I'm going to tell you that accounting should be always your best ally in managing your business. And if it's one of those things that you think you need to ignore, then that's signal number 1, it's not working out for you. But let's really focus in on ROI here for just a second. Here's the easiest way to think about what is really the return about good information and a good accounting system. So I want you to think back over your entire career, especially the career as a business owner. And I want you to think back and think about the 3 biggest issues, errors, and mistakes you made as a business owner, right? And when you think about those, quantify how much that cost you, either an opportunity cost, hard money, or whatever the net worth, whatever the case may be. How much did those big decisions cost you? I'm reading a book right now called The Road Less Stupid, and it's really good because it talks about this concept. But as you think about the 3 biggest issues, mistakes that you made in business and how much they cost you, for most people, that's easily 6 figures. For me, in my previous business, it was 7 figures easy and probably half of my net worth by the time that we got through working through the Great Recession. So when you think about that, and you think about those 3 things, then look at those 3 things that you just listed out and the dollar values that you put beside each 3. And I want you to think thoroughly about which one of those things may have been prevented if you had better information, more timely information, and had fewer questions about your accounting staff and more reliability as an ally in running your business. In a very simple form, that's the ROI of accounting and why everybody should know that it's working well, investing well, and making sure that it's truly your allies. Now, as we go through this series, one of the other things that I want you to always think about is when it comes to numbers in your financial statements, well, they're nothing more than a reflection of your people, their behaviors, decisions, processes, and systems. Truly. Accountants don't make numbers. CFOs don't make numbers. You don't make numbers. It's your people that make the numbers. And if you don't change their behaviors, well, you're not going to change your numbers unless manna from heaven just falls in your lap. The role of really good accounting and the role of a good CFO is to educate you and your people about where, if they make changes in their behaviors, how that changes the profitability, cash flow, and value of the company. Really, in that regard, that whole accounting CFO function serves as your chief financial education officer to help you make those better decisions. But more importantly, educate not only you, but those people below you, because they're the ones that are making things happen every day. And the more they understand about how their actions change the numbers, the better your numbers are going to be. Now, for a lot of people, when we're talking about your accounting staff, and we talk about controllers and CFOs and everything else, ideally, especially for the controllers that are in my crowd today, because I know a couple of you are out there, this is what we typically visualize. Now, we have a typical controller here on the left. Young lady looks bright, enthusiastic, very well organized. Just look at that office, and it kind of reflects old school accounting, because all those folders and 3-ring binders back there is what we would typically have for our close binders, where we would put all of our files, our reconciliations and supporting documentation. And anytime somebody had a question, we'd reach back there, pull it out, open it up, and go right to the page where all the supporting documentation was. It was very easy to validate what is or is not there. And while computers are our friends, computer actually makes it a little bit more difficult to see that sometimes. But obviously, young lady is very well organized, looks very sharp, on top of it, working on her numbers and everything else. That's the quintessential picture of what we want to see for a good controller. On the right-hand side is what we really want to see for a CFO. The difference is, while the CFO knows how the accounting shop is run, because probably 60% of them came from the controllership role, they really become more of a conductor of the numbers about how they're produced. They become a conductor of the reporting, and they're really a navigator for the CEO, that partner role that we talked about. And as that partner role, they are a user of the information as much as they are a creator of the information. So that's really important to understand, that while they understand how close works, they understand how accounting works properly, they also know when the accounting shop is working well to make corrections, but they're not necessarily going to be in the weeds. They are creating and relying on that same infrastructure so they too can make great decisions. Now, here's the problem. And this comes up all the time when we're talking to banks. In fact, banks end up being our number 2 referral source for this very deal. They'll call us up, Burt, we got a client, and I'm telling you, the people in the back office don't really have a clue, right? They tell us that they have a controller, and we're looking at their books, and they're just a flipping mess. Now, how does that happen? And here's sometimes the picture that we find when we go into those companies or talk to them. This is their accountant. Now, I'm not saying disparaging remarks regarding the accountants in the room, but what happens too often on small businesses is the entrepreneur is a loyal, hardworking person. And they found somebody early on that is loyal and hardworking too, that was their bookkeeper, that ultimately graduated up in the company with them. So what do you do with somebody that started out as your bookkeeper and they've been there 5 years? Well, you promote them to manager, assistant controller, controller. Suddenly, after 10 or 15 years, that same person is your CFO. You've given them a title, you've given them a promotion because you want to reward their loyalty. And what they really are, in too many cases, is a bookkeeper with 15 years of experience and knows your business really well. But they still may not be as good of a bookkeeper as somebody else, right? Because unless you've spent money in developing them and their professional deal through training, through courses, maybe going back for their associate's degree in accounting, then they're still the same bookkeeper with still the same experience working on the same system. And even if you have a bookkeeper that you hired externally, that person may be radically different because they came from a wider variety of experiences that they've seen company A, B, and C. They've learned from a controller, they've learned from a CFO, they've learned from a good accounting manager. They've seen different, what I call, pictures of the puzzle box. They've seen different ways that things work. So if you only have the bookkeeper that you hired years ago and they've stayed with your company, know that that's a severe limitation about, are you getting enough of the right eyes? The other reason I have the picture of this young man on is frequently the reason that information is not meaningful to the CEO is accountants love data. And they frequently think that the more data that they share, that the more meaningful everything must be. And that could be not further from the truth, right? We actually had one accountant and a really bright gal that was doing their accounting. She was working remotely, and when close came, her idea of providing the information to the CEO at that point in time was to hit a print button from miles and miles and miles away. And on the CEO's credenza back there. Suddenly the printer starts whirring and chiming and everything else. And out comes a stack of paper about a half-inch thick of all the reports that were supposed to represent the financial statements at that point in time. Now, I don't know about you, but I know very few CEOs that have the time, patience, bandwidth, and skill set to digest a stack of papers that big. Because there's this huge dichotomy between data and information. Data could be dumped on anybody's desk in a big stack and says, answer's in there somewhere, boss, good luck. Information is when the answer is popping out to you. Really good systems, we will say that the information or data chases the decision maker, that the interesting points are so self-evident. But sometimes when you don't have a good accountant, they don't understand their own information. Therefore, they're not good about understanding what they should be presenting to you. So that's really very important, especially as you go through this. And we're going to go through some other symptoms about when you likely have a problem with your accounting staff. Now, one of the ways that we can really ascertain what role do we have? Is it what is this person that I have here? What is the appropriate title? Well, this is a good way of determining, do you suffer from title inflation? Title inflation is when you have a bookkeeper that you're calling a controller or you're calling a CFO, and they're really still a bookkeeper. I don't care how long they've been there. So what is a bookkeeper? A bookkeeper is really somebody that's focused on your transactional level of work. That's all it is. They do the billings. They take in the cash receipts and they post them against the outstanding invoices in AR. They will process your vendors' invoices and put them into AP, and then they'll, once you approve and submit payments, then they'll post the payments against AP. So AP, AR are running okay. And if you have inventory system and it's really a pick, bill, and ship deal, then that's probably could be working okay, could be. And sometimes they'll do payroll. But all they're really doing is the transactional stuff, right? They may not know that it's going into the right place. They're just going, it's AP, so I'm processing this. It's an expense. I think I put it over here. Maybe I put it over there. It might be an asset. I'm not really sure what to do with that, so I don't know where to put it, so I guess. Or I ask the CEO, where do you want this thing to go? Because I'm unsure. No offense to you CEOs, but you're probably the wrong person to ask. And we're going to tell you why later on. So they are basically your transactional expert. Some of them you may see down here will actually deal with your bank reconciliations. That's a pretty good deal. That's a pretty good deal. Most of them really don't have a good understanding about what is your financial statements, what is it supposed to be, how should it be organized, and stuff in the right place. They'll print it off, they'll hand it to you, and then if you ask some questions like, well, I don't know. I'm just in the transactions. I don't know what that stuff means. The accounting manager is a big step up. The accounting manager actually knows a good idea about where the information should appear in the financials, why certain accounts are used differently. What does it really mean to have current assets versus long-term assets and things of that nature? They're much more in tune with that. And at this stage, you probably have somebody that is reconciling your entire balance sheet. They're going, man, what do I care about as far as doing the reconciliations on my balance sheet? Well, this is why you care, right? Know first and foremost that if your balance sheet is wrong, so is your income statement. No exceptions. There is no exceptions to that rule. So that's really important, because how many of y'all spend very much time at all looking at your balance sheet? For most mid-market and entrepreneurial CEOs, it's very little. I'll look at my cash. I might look at my AR, things of that nature. It's very high level. Now, if you are an auditor in a public accounting firm, they spend about 85% of their time looking at your balance sheet, or the things that drive, the processes that drive what's hitting your balance sheet, because they know that that's where the proof in the pudding is. And if the balance sheet is correct, then the income statement is correct. It just may not be in the right place on the income statement. We call that, is there a geography issue about where it's appearing on the income statement? But the income statement as a whole is correct. Now, again, that's really weird in an entrepreneurial world, because I will guarantee you that an entrepreneur spends probably 85% of their time looking at the P&L, and any residual time they may glance at the balance sheet. They're not really sure they understand it, so they move on. We're going to touch more on that later on when we get to there. But an accounting manager with those reconciliations and running the reports for you is really your first step about real accounting. Your controller. This is a very significant role when done well. The controller is not only focused on the same reconciliations that the accounting manager is, they're focused on making sure that close goes well. That month-end close out, the month-end reconciliation, the month-end reporting, the month-end distributions of information to the rest of the team is going well, right? So that's a very important. They're typically going to be people that are coordinating with your tax CPAs, your external financial partners, maybe sending things to doing some tax filings, your sales tax, your franchise tax, maybe your property taxes, certainly your payroll tax. They're going to make sure that those things are all working properly. They have a good understanding about where things should and should not be in the balance sheet and income statement. They should have a really good understanding about what created one big change in numbers from one month to the other and be able to explain to you why that is or is not legitimate, right? So one of the things that you'll find out, though, is that sometimes for a controller, when they have the title and they're not doing it well, is all centered around close. So close, as we'll talk about later on, is a key indicator about whether your people really have a good grasp on accounting as a function, right? So listen for that later on. Some of them, if they're really good, they're actually going to help you prepare budgets, but that's generally like, oh, we have revenues, we're going to increase them by 10%, we're going to move these things other by 5%, and there's our budget. It's not really a budget. That's playing games with numbers because there's not a plan in place. Some of them actually do good budgets, like counting on head counts, new market share, independent trade, but that's unusual at that level. Your CFO, again, they're the ones that are really helping you to navigate the business. They are users of the financial information. They're the ones that maintain control over cash. They're the ones that make sure that you have enough fuel in the tanks to get to your route as a pilot. But in that regard, they are your financial partners to make sure your company is okay to get to the course and path that you want to get to. They also help to manage all your financial vendors. And that's really important for your banks, your insurance company, your healthcare brokers, your bonding company, and possibly investors or potential buyers of your companies. They're going to be that chief translator. They're going to be the translator, the financial translator. I know it sounded like a hard word. It was hard to come out. Just sometimes while the camera's going, this stuff happens. But they should be your financial translator for all these other activities that are going on. You know, I was in a meeting one time with a really great entrepreneur, fantastic guy, and he was talking to a bank, and I felt like kicking him under the table because he was bragging about certain aspects of his business that I will guarantee you the bank was registering as, that's not good news. That's more risk for me. I'm not so sure I want to be here, right? Because what he is bragging about is this incredible strategic relationship he had with one primary vendor that they had finally built into where that vendor represented about 85–90% of their total supply. That was called concentration risk, right? So we had to interrupt real quick because I knew how the bank was receiving that information. Ding, 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 not good news, not good news. And start talking about how we're actually trying to discover new vendors of comparable quality to diversify that issue. So you want to have a good CFO that also serves as your chief translator, financial translator. We almost did it again, didn't we? To move those things forward. But more importantly, a good CFO is helping you to understand the actions that needs to happen to create that new future and how to make those levers real. Again, changing those behaviors. So now that we've gone from bookkeeper up to CFO, are you getting a better understanding about what you likely have and where they stand in and being able to do it? So another way of understanding what role you have is really looking at the span of influence they have within your company. This is really important because your bookkeeper, oh gosh, they're kind of in the back office. They're cranking away on those numbers every day, and they kind of stay within that realm, and they'll especially if you're doing payroll, they're starting to affect other administrative departments, but modestly. Um, and they may participate in expense accounts or things of that nature. Now, your accounting manager, excuse me, will get a little bit further along. They're definitely going to be probably involved in HR as far as, again, even deeper on the payroll setup. On the operations side, they may be issuing out some reports or certainly asking for those expense reports and helping to herd those things down and make sure that they're done and accounted for timely. Your controller really gets the entire accounting and admin department. When you're at a controller level, generally speaking, you are going to have a bookkeeper and or accounting manager underneath them. Right? It's pretty typical that you're at least going to have one, if not both those roles underneath the person. They are going to be more involved in the operational side of the business, helping those people to understand where they are in their budgets, their reports, what's causing unique changes in their numbers. Do they have enough budget to hire people, things of that nature. On the leadership team, they're somewhat involved in that they're providing the financials. A really good controller is going to explain the financials to your leadership team. We call that a financial summit. Then lastly, on the external financial and strategic partners, they might be sending your financials to the CPA, but not really doing tax planning with the CPA. They might be sending occasional reports to the bank or your borrowing base to the bank, but there's very limited involvement with the external partners. The CFO really spans all of that. They should be heavily involved in all these areas. And not just little segments, they'll be playing a big role in all these areas. Because again, you go back to, they need to be the chief financial education officer to help your people make better decisions and in dealing with the external partners to get good deals and to sell a good outcome about the strategy and financial stability of the company to those people. Again, the chief translation officer did it well that time. So again, this is a useful tool when you step back and says, what is it that I really have? Have I been calling my bookkeeper a controller? Are they really providing this level of value? Because if not, then know that the closer you are to the left-hand side of it, the lower the value is of the information that's probably coming to you as a chief decision maker. That's just a universal truth. So some of the key things to look out on your staffing, and these are key indicators that you have a problem with your staffing, and I don't care what role it is. Number one, and this primarily relates to the bookkeeper and the accounting manager, is yesterday done today. So what that says is, if it's, today's Tuesday or whatever, I want to make sure that by the end of Tuesday, all of Monday's transactions are in the books, no exceptions. Deposits, billings, receipts, deposits, payables, invoices, payroll, all those transactions from yesterday are in the books today. No one goes home. Now, why does that sometimes not happen? The most frequent reason is because of you, the business owner, right? Because you don't understand the process of accounting, sometimes the urgency of your needs for analysis or reports interrupts that flow of what should be happening every day, and then it doesn't happen today. If that goes on and on throughout the week, like you have a pretty chaotic week, then the entire week's worth of transactions aren't posted, which also means that any of your interim reports, you want to see a sales report, you want to see an expense report for week by week, it's not accurate. You might as well not look at it, because you're interrupting the flow of the transaction and the posting of those transactions to make sure the information you're looking at is good. So here's one thing to think about as the business owner. Kind of set that expectation with your people that yesterday is done today, or else, we're not moving forward, and give them the permission to block out a certain part of their day. I usually recommend at the beginning of the day, right? You're going to come in at 8, you're going to work until 12. We're going to prove that everything's in the system. You've double checked it. And then you can come out of your back office and start engaging with the rest of the world to be helpful and solve today's urgent matters. But it's important that everybody respects that the accountant, the bookkeeper must get today's transactions done, because it only gets more diluted about what happened over time. and the catch up gets worse and worse and worse. Number two, close this game. Close is a very good indicator about whether or not you have a good controller that really understands the company and really understands the accounting process. The timing of close is critically important. Now, it's not important just because we want to close earlier, but an early close tells you something very important about your business. So when we think about this, the number one thing I want you to know about your accountant's role, especially your accounting manager or your controller, they really have one job, and it's a manufacturing job. We may think it's accounting, but it's a manufacturing job. And what do they manufacture? They manufacture one thing, and it's your financial statements every month. So they go through this manufacturing process, they issue reports, the production run is done, and then they get into pre-production mode for the next month. It's literally a production job. So if you're closing on the 5th, right, that's fantastic, right? Because information is getting you very quick, very soon. It's very live, it's very actions, it's all tangible, it's very exciting. What it also tells you, if they're closed on the 5th or the 10th, then they have the rest of the month to be working on the analytics you need to feed your decision making. And they also have that time to improve their accounting processes and help the rest of your functional leaders. But if they're closing on the 20th, the 25th, or the 28th, they literally have no time to help you out, to give you the analytics you need to run your business, to run, one-off ad hoc queries, or to help out the rest of your leadership team, because they're still in chaos mode, fixing the numbers for that month. To make matters worse, if they're taking longer than a month to close your books, like it's the 15th of March, and you're still trying to close January, it's a huge problem, right? Hopefully, they're working on helping you clean up a huge mess and get that closed back on track. But if that is a systemic problem to where they are closing on the 15th, closing beyond a month, it's a huge problem. They are telling you, I don't care what financials they give you. I'm telling you, there's a huge problem with your financials. And you need somebody else to look at. So, data dump versus guided tour. We talked about this a little bit earlier on. The joke I used to make is sometimes you would have the accounting manager or the controller understand that they went into accounting for a reason, right? They like going over here and doing technical stuff, and we're going to leave some of the human stuff over here because that's not really where I get my big. It's not that I don't have friends, I have friends, but I don't want to be out here doing all that other stuff. And what does that mean? It means that your accountant is frequently conflict adverse. They don't want to have an argument, right? They want to show you the work they did and get out. And hopefully you'll understand it, because they're not your salespeople for sure. So they're not used to presenting and cajoling or explaining or selling or any of that stuff. So they want to give you the numbers that says, these truths we hold to be self-evident. I'm sure you understand as well as we do, and I got to go. I literally used to joke that sometimes you'd have an accountant that likes to sneak in under the cover of darkness during the night, slip the financials on your desk, get the hell out of your office before they are ever caught, and only come back in if you ask a question. Okay. That's not good. So if they just dump data on you, that might be useful for them, but it's not for you, because you don't have the time, and quite frankly, most of y'all don't have the skill sets to digest a whole bunch of information. Now, if I look at a spreadsheet, I can see patterns in the numbers pretty readily. Most people that are outside of accounting can't. So getting down to critical information, well organized, and in the reporting, variance reportings and other things, KPIs and metrics, crucially important to help you understand. Here's the other thing about why a guided tour is very important for the entrepreneur. 80%, I think it's 80% plus of entrepreneurs are visual or tactile learners, which means that when you see a big spreadsheet, it just looks like a mess. It doesn't resonate to you. A visual learner, which is why a visual learner sees patterns, it has visual cues about what's on track or off track, And literally, that's why your dashboards are so important, because it translates critical information to a way that is appealing to your unique learning style that has made you successful all these years. So when you have financial information, start asking for critical metrics to move it to where it feeds the way you learn. And the overriding deal is the job doesn't start just because we hit print on clothes and print out a bunch of stuff. It's the explanations and the education that make that job really complete. Lastly, are your accountants speaking Klingon or are they speaking English? Now, I'm kind of a Trek fan. You know, I've watched most of them. I still don't speak Klingon, not that I want to. But if your accounting folks are stuck in I don't knows or jargon talk and aren't able to switch over to English and converse with the rest of the human race, it's also a problem. I don't care how smart they are. If they can't explain what they are doing in a way that makes sense to you, it's a problem. It's a real problem, especially if they've combined this lack of English use in accounting language with the fact that they don't have metrics, they don't have dashboards, and they don't have trends analysis. Big problem. Because what typically happens when an accountant is up there, even if they are doing a presentation and they're speaking jargon, you know what happens? The rest of the team is tuning out. Here's another thing that's really very important as we bridge the gap between reporting and accounting. There's two things that I'll encourage. Number one, you, the CEO, here's the number one thing I want you to do when you get your financials from your accountant. Don't look at them. Don't look at them. Don't dive into them immediately. Don't do any of that. Set it aside for an hour, a couple hours, and I want you to think, maybe go on a walk, whatever, you know, just some quiet time and reflect about what happened in your business in this last month. What are the key sales things that happened? Did you move some big equipment? Did you hire some people? Did things go well with that new customer launch? Was that new vendor that you brought on board? Did those problems on that big project get corrected? What are the things that happened in my business? And when you kind of have that mental picture about what happened, then turn over your financials. When you turn over your financials, then you're going to have certain expectations about what you're going to see now. That's very important because now you can ask extraordinarily good questions when you're looking at your financials. Like, whoa, I thought we had that big sale that went out to Peggy Sue's. Why does this look like we didn't have that big sale? So you can start asking really good questions if you just hit that pause button and turn it over. Now, for my accounting friends out there, here's the number one thing that I want you to do, because this is crucial to your credibility to everybody else in that room. If you're asked to present the numbers, don't do so the hour after you finish close. You need to step back and look at the numbers that you're getting ready to present and look for the weird relationships about what is this number versus that number, what caused that change. Because the number one reason that accountants lose credibility when they're visiting with non-accountants is somebody will look at some weird relationship and the person goes, I don't know. I didn't see it. Let me go look at it. I don't know what caused that number. And you just validated that the Klingon problem is a real problem, and you've lost them for the entire presentation. You do that too many times and you're going to lose them forever, and that means you're losing credibility. So step back from the numbers. Don't run from your PowerPoint straight into the boardroom to go present stuff that you haven't reviewed, digested, and ready to answer those weird relationships. Just tricks of the trade. You'll thank me later on as soon as somebody asks a weird question that leaves you flat-footed. Next, now that we're into reporting. Reporting is how you discover the problem. It's not only the problem about whether you have accounting, it's the problems about what you may or may not have in your company. So great reporting creates awareness and insight for decision-making, proactive decision-making, not reactive, house is on fire, somebody get the water, the bank called, said that we're all blown up and everything else. That's reactive. Good information allows you and your team to be educated financially, Chief Financial Education Officer. And good information goes back to, it allows your people to understand where to make changes to their people, decisions, behaviors, processes, and systems. Because I don't care how good your strategy is. If you don't know where to change those things, you're not going to change your numbers because it's your people and all those other things that create your numbers. So that's where the really strength of reporting comes in. So let's start examining, what does good reporting really look like? We talked about a data dump, where it's just a big stack of stuff that comes in and plops on your desk or whatever, and may or may not be explained. And God, I hope you understand all that stuff. And my job's done because I got to go back to my production job and start all over. Your financials should actually look like this iceberg. And what is the universal truth of the iceberg that's kind of evident right here? I think it's 10% of the iceberg is above the water. The other 90% is below the water. Your financials should look the same. Your financials represent the 10% that's above the water, right? And should be meaningful enough to tell you what's going on with the company holistically without you having to dive and go swim around the other 90% to see what's going on, because you don't have time, right? A good financial system or a good iceberg should also say, hey, that part over to the right-hand side, something's wrong. That's where you need to go look and see if everything's okay under the water. So your financials should not only be organized like an iceberg where the top 10% tells you how the rest of it's doing, it should also tell you what is not working well. So here's a different way that I want you to think about your financials as far as, where do I go look? Where are the problems? What is this really telling me? So think about your financials being organized like a decision tree. So if I have revenue, is my revenue changes because I had mix issues or price issues, or what's going on there? It could be volume issues, volume, mix, pricing. Those are the big three drivers. And then that gets more bifurcated depending on how many lines of business you have. And then within mix, is it recurring or is it projects? And we're going to touch base about that, I think, in the next slide. But as you start to look at your financial statements as though it's a decision tree, you're going to understand the decision behaviors a lot better. In fact, when it's really well done, everybody in your boardroom will walk out there and go, oh, wow, that was my number that I own right there. And I have three drivers that affect that number, and I know what to go out and do. That's what you really want. Numbers, when well presented, equals a management team that understands what numbers they own and what actions they need to take to change that number. So when we think about it that way, we're just going to look at like revenue. Hopefully, your revenue streams aren't just a big block of revenue. Because I'm going to tell you right now, not all revenue is created equally. So we've all heard about the value of recurring revenue. And as you look at your revenue value streams of revenues, I would want to know what my recurring revenue is, broken out differently than my project revenue and things like that. So I want to look at my lines of business like, not like, oh, it was food type A and food type B. I might want to see, oh gosh, for a car dealership, obviously I want to see car sales. I want to see all the F&I, the finance and insurance sales, and I want to see the maintenance and the repair shop sales. Those are radically different revenue streams. And so if I bundle those all together, it really masks the high value revenue streams, which is the F&I department and the repair shop of the service center. You know that most car dealerships, unless they're the luxury car dealerships, really don't make money on the sales of the car anymore. It's in those other two shops. And if you don't understand the quality of that revenue, you're probably missing out. The same thing is true in your business in a certain regard. So understand those things. So recurring revenue, very valuable because it's low risk revenue. It's low risk because it has a high probability of recurring month after month after month without having to do a bunch of heavy lifting. Now, if we go all the way to the other end of the spectrum, let's look at project revenue. I know this pain really well because I used to own a construction company. And in a construction company, your revenue is based upon I bid, I win, I execute, I bid, I win, I execute, I bid, I win, I execute, all over and over and over, which means every January, my revenue is starting from scratch, starting from zero, and I'm recreating it. So unlike recurring revenues, I have no assurance other than hopefully I keep the same salespeople and they work as hard as they did last year to recreate the revenue. The only way I grow my revenue is if I bring on more and more salespeople to try and penetrate more and more of the market to create what they did over and over again. And then other things about, you might look at customer concentration. If I have Walmart as a customer, and they represent 50% of my revenue, I darn sure want a report that shows me how much was Walmart this month, and are we moving Walmart down to our ultimate goal of only 25%? So look at those things, helps you to understand how healthy your business is. Another way of looking at it, this is key, going back to that thing about most entrepreneurs are they're visual and tactile learners. So I want you to start looking at your trends and comparisons, because those are critical. Now, for most of y'all, if you're looking at a big spreadsheet, you don't really see the trends. You might see, oh, well, revenue went kind of up and down, but that may not be the trend, because a lot of times the most important trends are the ones that are interrelated to different parts of your income statement, which for the average user, you're not going to see, which is why KPIs are so important. But there's some simple trends that you can get into that are equally as important. So I put down there at the bottom, just comparing it to prior month, right? If your accountant, bookkeeper, controller, whatever is only showing you 1 month of financial statements, you're being robbed of critical, good information, absolutely robbed. At the very least, you need to compare this month to last month. And then there should be a column of variance, what changed. Oh gosh, this went up by, $50,000. And a good accountant will have that explained. Oh, that's because we did X, Y, and Z. We had a warranty claim. Peggy Sue bought that product that you were looking for, whatever. So that starts to align with what did you think about? What were your expectations? Those explanations should be right there. In fact, we have found that when accountants and controllers only show 1 month, sometimes that's an indication that they're hiding stuff, especially if they're taking more than 20 days to close, because sometimes they'll find stuff that relates to a prior period, and they're going to stick it in a prior period that they've already shown you. And if they're only showing you 1 month at a time, that mess that they just stuck in a prior period, you're not seeing it. I have a universal rule when I'm working with accountants that if you find a problem that relates to a prior period, you have to put it in this month. I want to see it, and you have to explain it. It's going to be painful, but it's less painful than the information being hidden from you. Because I will guarantee you, when those financials go to your bank, they're putting them in a system and they're looking at these trends and they're going to ask you about that. You go, what are you talking about? It was never presented to you. The other comparisons that you can make is versus a budget, possibly against a benchmark. If you don't have a good benchmark report, at the end of this, we have a QR code. You can scan it. You can send us a question and everything else and contact us. We probably have your industry in our benchmark database. Happy to share that with you. Or a trailing 12. But there's other things that we can use for comparisons, and trend analysis are really very, very key. And I'm going to give you just a quick overview about how they work within your financial systems. So when you're looking at your financial systems, there's relationships that you really want to see and hone in on. Like on your income statements, looking up and down your income statement for key relationships helps you to understand, is my business operating consistently? Is my business picking up operating leverage and productivity? So I make this joke sometimes that when I ask CEOs, name 3 things that you look at when you get your financial statements. And there's rarely 4, certainly almost never 5. But 1 and 2, maybe not in this order, are revenue and EBITDA. The third one is cash balances. Some of them will say AR, right? But for the ones that are looking at revenue and EBITDA as the 2 things that they're looking at, effectively, that's like looking only at the 2 pieces of bread on a sandwich. That's all you're looking at. And none of y'all buy a sandwich because of the bread. And whenever you do buy a sandwich, I'll guarantee you're eating more than just the bread, because it's the stuff in the middle that makes the sandwich so tasty. And the same thing is true with your P&L. There's a ton of relationships that are going on. Like if I see that my revenue has gone up by 15%, but my COGS has gone up by 20, I got a problem. Somebody needs to explain that, because I either have a one-time hit that nobody needs to explain, or something's going on in my operations and it's telling me something really critical, really critical. There could also be up and down relationships between things on your income statement and things on your balance sheet. Revenue and AR, they're directly related. The health of AR can be trended based upon working with those 2 dynamics. And then looking across or over a span of time can tell you really valuable things about your processes and your decisions. So I'm going to show you an example of an actual client from a while ago. This was their revenue and AR days. And yes, I get it that this is pre and then post pandemic, but the issues here were not caused by the pandemic. So when you look at it, you see revenue and AR days, and there's a pretty healthy, somewhat consistent gap in the first part of this, and then it flips hard. Not the pandemic. When we really started looking at this going, hey, what really caused this? You know what we found out? Around the time that right here, oops, let me move that. But around here, when these things really start changing direction, what we found out is like, what possibly happened here? You know what happened? They changed their standard contracts with clients. Not all of them, but some certain big clients. And nobody really ascertained whether they liked those terms or not. And they gave up the ghost. It was a huge impact on their business, but they went down there and nobody really validated and improved the revised terms in the contract because they allowed the customer to change the terms without the internal approval. It took years to unwind that. Years. So when you see that and you see, oh my gosh, something shifted, because you see a pretty big shift right here, that's telling you that a process has changed, and the faster you can find it and reverse it, the more important it is. Now, when you see those things happen and you see these kind of trends and relationships change radically in your business, the easiest way to think about that is ask yourself, what's more likely? Did a person change? Did I hire somebody? Did I fire somebody? Somebody been out sick? Or did a customer change their people, whatever the case may be? Because there's a person that changed that is not in tune with the historical tribal knowledge somewhere in the channel. Number two, did I change a process, right? In this case, it was a process that changed and changed radically. Number three would be, did my system change? Did I implement a new system for a new billing system, a new collection system, a new collection service, whatever the case may be? That will allow you to quickly ascertain where's my root cause and where to go fix it. It seems extraordinarily simple when you think about it like that, but it's really very powerful for getting down from 15 possible causes down to 3 in minutes. So as we go forward, what's some other things that we can look at? Well, let's go back to our friends that are the tactile learners and see how they're doing. This is what we typically use when we are dealing with our clients and their dashboards. So what do your dashboards look like? In this one, you can see that certain metrics are rated as critical. They're rated critical because we want to make sure that we are driving things towards either cash, or in this case, liquidity, because that was a big issue for this company, is they didn't have enough liquidity. So they put the liquidity metrics over there first. And of course, the red or green says that we're on track or off track. If you were to click on any one of these, it would show you a chart that shows over time, how has this thing been trending relative to the target? And are we still going towards the target? Are we still heading away from the target? Or we're just still running flat? Very important information. It says, are we making progress? Initially, this should tell you, are we there yet or not? When you click on the other graph, it would show you, are we trending towards that or not? And then we do critical, high, medium, low. And we'll set these up once a year with the targets in there. Everything has a target. Everything has a target. Then in the middle of the year, we literally try and work the wheel to where all the criticals become green, most of the high become green, et cetera, et cetera. And at mid-year, we're going to go, okay, if most of the critical and highs are green, we're going to do one of two things. A, we're going to move whatever is remaining red and make it critical. Or B, we're going to raise the target, right? Because what we always try to create, and hopefully what you want to see within your staff, is an appropriate level of anxiety for them to take action. So increasing that bar, raising the bar. You know, if you're a pole vault jumper, and you clear 10 feet, well, your coach is going to raise the thing up to 11. Same thing here. You got to clear a higher bar if you're going to win big. If you want to just win mediocre, we'll leave the thing at 8 feet. Nobody wants to win at mediocre. That's not the reason you created your business. So you want to increase these bars to make your folks stay slightly uncomfortable make them ask different questions, make them examine different ways of solving the problem again. Some of y'all ask, why is there low? Like, why do we need low priorities? We generally reserve the low ones for maybe debt compliance. What does your banker want to see? If you have something with the insurance or bonding company, we want to be monitoring that so that you see the company through their eyes. It may not be critical to you, but it's critical to somebody. We want to make sure that you're looking at it. Here's another version of metrics or a dashboard. Slightly different. We still have a result, a target that's either sometimes it's the budget or sometimes it's individual targets. These X's say we either met the target or we didn't. So you can say we're a few $1,000s off. These arrows say, where are we trending? Are we trending towards the target or still away? This says not only do we miss it, but we're trending away. Very important things. And if you clicked on any one of these, you'd see that same chart that I talked about last time. Here's what it looks like over time and where this trend is going. And here's where we're classifying. So we have target. Did we make it or not? Are we trending towards or away? Is this high or critical? Here's one where we did make it. And here's where we're making it. And we're, it's trending even better than target. Now, this last circle over here is red alert. It means not only did we miss it, but we missed it by enough that we determined in advance, this requires critical action and critical action now. All hands on deck, stop, drop, and roll. Somebody needs to go and solve that problem like right now. So it's different ways of creating that urgency and focusing the conversations in the boardroom about what needs to be taking place right now. Because there's no worse problem in the world than the one that lingers, right? So don't let it go 2 months. Have your system set up to identify it now and cure it within the next 30 days, and you're all going to be fat, dumb, and happy. Well, you won't be done at that point. You'll be very well informed and happy. The last thing that I'll tell you is when you're setting up targets, think about the canary in the coal mine. Silence is not golden. So how does a canary in the coal mine work for you in your business? It's a little bit like that red alert. So if you're looking at a business, you're like, okay, this is what success looks like, right? Here's the upper graph. Here's what lack of success looks like. Or if you think your business may be running towards some headwinds and might be struggling, you want a canary in the coal mine that says, hey, if sales drops 5%, that's our signal that the canary is starting to chirp a little less loudly. And what we want to do to create oxygen for the deal is we're going to put a hiring freeze on, right? But if it goes down 15%, the canary is really just barely whispering, and we're going to start cutting staff. If it goes down 25%, then we're going to close down those offices. If it goes down 50%, so the canary is telling you when to take drastic actions. What's really also very good is when you have this canary and you predefine the actions you're going to take, the canary lines, if you will, at canary line at 10%, these are the actions we're going to take. It is so much better than waiting until you get there and go, oh my God, we're down 10, now what? And the reason that's better is you decided on what the actions are when you are clear-headed, calm, and making rational decisions. If you wait until this stuff is on the fan, the odds of you making really good decisions and living by them is not nearly as likely, because that human thing called rationalization starts to kick in. Well, maybe not yet. I'm not so sure it's the right time. But if you determine in advance, oh, nope, these are the marks, and this is the action, you'll be stunned at how fast that takes place. Very important to have this canary in the coal mine kind of aspects. So as we're wrapping up the part about financial reporting, the thing I really want you to look at is your reporting an iceberg or a ton of floating chunks? Because if it's just floating chunks everywhere, you're going to be bumping into a lot of different stuff, and it really doesn't tell you about your business. It just gives you a lot of static that's hard to decipher. And you should know that the truths of your business should be more readily self-evident, right? They should scream at you. They don't need to be playing hide and seek. And then also remember that root cause identification, people, process, or system. You want to solve things fast in your boardroom, in your leadership team. When these issues come up, ask yourself, is it more likely it's a person process, or system? If so, let's dive deep. We can narrow that thing down and then have within probably a week a good idea what the problem is and be headed into the direction. This is a little bit more Star Trek deal. Is Captain, we have a problem. I go back to the dashboards. You should have metrics that tell you to take action. It's that appropriate level of anxiety to take action. Now, you may be like Captain Kirk and Scotty, to where Scotty always says it's going to take 5 hours, but he gets it done in 1. But at least he knows he needs to take action. And then creativity can kick in about what actions need to take place. How do we expedite that? How is there a different solution that it gives pretty much there that the Pareto deal? Can we get 80% of the issue resolved by doing 20% of the work? Or do we really have to do 100% to keep to 100%? Really, that whole thing is very important, because what you're going to find is if you act fast enough, it's not 100% of the things that have to be tackled to make the problem really go away. And lastly, a little bit of that red alert. Is this a retrofit in your business? Is that what your data is telling you? Or is it telling you that you need to drop the workbook? A little bit drastic there, but did you let the canary get quieter and quieter and quieter until you have to take drastic actions? Now, when I say that, you're like, well, the problem's still there. Why does it get drastic? Because if you take actions early, you stop the bleeding, right? If you wait longer and longer, you have to take bigger actions to have the same impact. So the metaphor that I use a lot of times for companies that are struggling is that of a train that is heading on, that's on a railroad track at a constant speed, heading towards a fixed barrier. That fixed barrier is when you run out of cash, and it's a wreck, it's a mess, stuff is everywhere. So this retrofit or drop the core analogy is, let's go back to the train. The train's coming down the path. It's a problem, but you identify it earlier. Well, you start to slow down the train to create time before you hit the barrier. That's eliminating expenses. That's possibly laying off people. It's getting rid of the unnecessary. It's closing down that unprofitable office that's been a Klingon forever. Sorry, more analogies. But slowing down the train. The other part is you could move the barrier further down the tracks. And that's possibly squeezing capital out of your balance sheet, really squeezing down the AR, your inventory, putting more money into it. If you're okay with borrowing money at that stage, going and getting money from your bank, or seeking out investors. But new capital infusion or pulling cash out of your balance sheet is what moves that barrier down. And that's the difference between, if you wait too long, you've already spent all this money that you could have saved. That's why when you get way down here, you got to drop the core, right? Because you have to take drastic actions if you wait too long. And if you do it up front, then little actions, because you're saving all this cash along the way, it's more of a retrofit. You don't have to drop the core. So overall, I hope this was helpful for you. If you'd like to visit with us again or have questions on this meeting, just scan the QR code that we have here. There'll be a place where you can fill it in. If you want to get the benchmark reports that I talked about, happy to send those out to you. Again, there'll be a form to fill out. And while this says the first Fridays of every month, it is the first Fridays of every, no, it's the third Fridays of every month. So ignore that, because when we do the next rendition of the wellness, it's going to be in the third Fridays of every month. We used to have a thing called Ask Me Anything. But we've morphed that because people didn't really want to talk about their financials in an open forum, so we morphed away from that. But the next wellness will be on the third Friday of June. We look forward to seeing you then, and I hope you all have a great week. And again, thank you very much for your time. I've enjoyed every minute, and I hope you did too.